All right, guys, welcome to day 6 of the Trading Academy. All right, in today's video, we're going to be talking about liquidity. All right, introduction to liquidity. What is liquidity? All right, liquidity, and you're going to hear this term a lot being used in this academy a little bit later on, but liquidity is basically stop losses above swing highs or above swing lows, old swing highs, old swing lows. All right, really above any low and above any highs of liquidity, but mainly above the swing highs and swing lows. So it's going to look something like this, right? So you'll have a high, you'll have like structure like this, and then it might, go up and then go down and take out this low, go up again, boom. All right. So liquidity, in a nutshell, in the most simplest, way I can explain it, liquidity is just going to be where stop losses are placed, right? Where retail is going to place their stop losses. That is basically liquidity in a nutshell. Okay, so for example, like what is a stop loss, right? I know some of you guys might have not, you guys don't know what stop losses are and stuff like that. A stop loss is basically when a person gets into a position, right? Let's say a person gets into a short position, right? He wants to make money when the market's going down and he's following a bearish trend, and he wants to put his stop above the most recent high, right? And he gets into a position right around here. A stop loss is basically going to be an order where in case price comes up, it's going to stop him out. It's going to get him out of that short position so it can minimize his losses. Okay. So you're going to hear me saying that a lot, right? Stop loss, take profits, right? A take profits is the opposite, right? It's going to take profit at a certain level wherever he puts it. Stop loss is basically just, wherever the trader places a stop loss, that's where the order is going to come in to take him out of that position so it can minimize his losses, right? It's literally in the name of what it is, right? A stop loss, right? You stop the losses, you stop more losses from happening, okay? It's basically where traders have their orders, right? And it occurs mainly at the swing highs, right? And the swing lows. That's where liquidity is basically going to be at, all right? It's going to be above swing highs and below swing lows, all right? So like right here would be an example of another point of liquidity right here, right? Take liquidity out there. And then again, right here, there's another swing low right there. Take liquidity out there. And usually, if it is a liquidity sweep, right? If price or if the market takes out liquidity, it should have a nice reaction, right? Here, it takes out more liquidity, right? And liquidity can come in a lot of different forms. It can come in, again, swing highs and swing lows, but we'll get into that a little bit later in next week's video and drawn liquidity. But it could basically come up to equal highs as well, right? So with price action, you'll notice if you guys have been in the charts, studying market structure and stuff like that, you guys will notice that sometimes price will come up and it'll form like relative equal highs or perfect equal highs or just highs that are very relative to each other like this, something like that, right? This is where a lot of liquidity is being built up, and that's where price will draw to take it out, right? Liquidity is just basically just swing highs and then stacked or relative equal highs and lows as well, right? So if you have something like this too, where price is just stacking lows, people will call this, like if you guys have been studying trading or you guys have been on YouTube or whatever, people will call this support and resistance. Now, we don't play by that idea or that ideology. We play by, market going to take their stop losses out, right? We're trading against these type of traders. So these traders will think that this is resistance, and yeah, it might work out a little bit, but we are betting on the fact that price is going to go up to that and take out that liquidity, right? Their stop losses, these traders right here that are saying that this is resistance, this is support, we're trading against those type of traders. All right. Because those type of traders have their stop losses above here, right? So if they have their stop losses above here and they're shorting right here at resistance, aka resistance, right? We're not playing by that idea, right? This might work out for a little bit, but they'll have their stop losses right above these highs, right? They'll have their stop losses right above those highs, and the market usually will draw up to their stop losses and take them out, right? Take out their profitable positions or whatever they have left if they didn't trim or if they didn't take any take profit. The market will reverse and take out liquidity and vice versa over here. So any traders that got into any long profitable positions over here or over here, they have stop losses in place because they're still in profit, right? So the market, what it'll do, it will it will go down to that liquidity, their stop losses, so it can get more fuel for the next move. Think of it like that, right? It's very simple. It's the market's job is just to get out traders and get in traders, right? It's taking out traders to bring in new traders. All right, think of it like that. That is basically liquidity in a nutshell, right? I just want you guys to think about it like that. Like if we go down here in the market, right? Again, this is relative to all the charts. You guys will start seeing that, you'll start seeing like, okay, this is liquidity, that's liquidity. All right. So this swing high here, like up here, this was liquidity, right? Market came up, right? Because people, right, market participants they were profitable on these short positions, right? So they were holding, so they have their stop losses up here because people think it's resistance, right? On the lower time frames, you probably see like a resistance zone building here. Don't worry about those terms. We're not using any of that. I'm just saying that these are the type of traders we're trading against. This is the type of ideology we are trading against. So market comes up, takes out the liquidity. And guess what? People that go long here, expecting a bullish trend, right? They'll have their stop losses either here or here. And look what the market does, right? The market comes after sweeping the top of that liquidity, after seeking those traders' stop losses, sweeps it, and then it comes down and seeks the opposing side, right? The other traders that are profitable in long positions that still have positions open, they'll have their stop losses below these lows, right? Boom, swing low, right? And look at what the market does, right? Comes and sweeps all these lows. And then traders that had even more long profitable positions over here, they have their stop losses down here, right? At these new fresh lows. And guess what? Market, after taking these guys' stop losses, reverses and takes out anybody that was long and profitable in profitable positions over here and over here. They all got taken out already. All their stop losses are taken out. That is basically liquidity. This is where you would look for liquidity, right? And sometimes, price is not immediately going to go over and take out whatever liquidity is here, right? So say that there is people short right here, right? Now that we've already taken out all this liquidity here and we're taking out even this one over here, right? Look, price comes down, sweeps that low, takes out those people's stop losses. Anybody that was long over here in this area and they have their stop losses down here are out of the market, right? Think of it like a game almost. People that are short up here obviously have their stop losses right here and right here, right? So they're in profitable positions for a very long time, right? And then as you guys can see, the market will seek that liquidity eventually, right? Now this is fractal, meaning that this works on every single time frame. Right now I'm on the weekly time frame. So this takes a long time to play out. This took about 2 years to play out, okay? But again, this is fractal, right? This happens on the 1 minute time frame, right? If you were looking at this chart as a 1 minute and each candlestick represented a minute, this would work as well, right? This would happen in about like an hour or two, okay? So for example, here, there's liquidity everywhere, but let me give you guys a pretty clear example here. So let's see if I can find some equal highs here that I could show you guys. Let's see. So sometimes price, we'll just pretend that these are equal highs, right? Because sometimes price will, let's just say fuck it. We'll use this as a swing high, right? This is a swing high right here, 3 candle formation. Remember, 1, 2, 3, right? Highest point of the 3 candles right here. So this is a swing high. This is where traders that are short, that went short anywhere around here, retail traders, because what they're doing, retail traders, they're thinking that this is resistance, right? So they're putting their stops here. They're putting their stops up here, up here, up here. Okay. So the most recent one though, is right here. Even people that were short, that got in short anywhere in this area, they're already stopped out because this price leg here swept liquidity. And then it came down, swept short-term liquidity on the other lower time frames. And now anybody that's positioned in a short is in profit, right? They're making money when the price goes down. So now price is going back up, and eventually it comes up, takes out that short position trader that is in profitable shorts since over here, right? Price comes and it seeks all this liquidity, even in here, right? Seeks all this liquidity right here, right? Above these highs, above these highs, above this high, and now above this main high where people have their stop losses, right? And this is internal liquidity. We'll go over that in a more advanced section of the academy. Right now, this is just introduction to liquidity. What is liquidity, right? Like for example, you have these relative equal lows right here. and we'll go over into why these didn't sweep right here, but that'll be in a more advanced section of the academy. Right now, again, it's just intro to liquidity. It's just basically stop losses above these highs, above these lows, right? This is where traders are going to place their stop losses. This is where the market will draw up to get fuel for the next move. Think of it like that. Like the market is gassing up. It'll come and seek liquidity. It'll get traders out. It'll get these traders out that are positioned in shorts, and then it'll knock them out and then go in the direction that, these traders were hoping for. And it did go for a little bit, but it reversed, took the rest of the traders out, and then it fueled up for the next leg down, right? And then we come down to take out all this liquidity, right? Take out that liquidity, take out that liquidity. And then there's a reason why the market didn't come and seek this. Sometimes it won't, but there is a reason for it. And we'll go over that reason later in the academy. Right now, I'm not going to mention it because, again, this is intro to liquidity. I'm just trying to get you guys familiarized with liquidity because that's going to be the main thing of this whole academy. Without liquidity, there's nothing, right? You need liquidity in these markets. You need other traders because trading is it's a PvP type of thing, meaning player versus player type of thing, right? When somebody sells, somebody's making money, right? Somebody loses, somebody wins. Okay. When somebody buys, somebody wins, somebody loses. All right. And vice versa. It's a player versus player market. And you kind of just have to think about it like that. Is people will place their stop losses above these swing highs or swing lows. And your job is to try and find out where market is going to go to attack those stop losses. So that way you can make money and essentially they lose money or they get knocked out of their positions. Okay. Sounds fucked up. Sounds messed up, but it is what it is. This is what the market is. It's a player versus player market, right? It's a player versus player environment. So that's what this is. That's what liquidity is, right? It's basically, again, just a quick recap. You'll have your ranges. Sometimes you'll have your swing highs, your swing lows, and then you'll have your internal liquidity, like I just mentioned a little bit ago. But basically, that's just what it is, right? You'll have stacked highs, and the other traders that are trading against you, they'll say that this is resistance, and it's not. All right, this is where people have their stop losses at. This is where the market will come up, gear up, take out their stop losses, and gear up for the next leg. For example, like in this drawing right here, we have stacked relative equal highs. Market comes down, sweeps that internal low, right? This is kind of a little bit more advanced, but again, this is just essentially what liquidity is. Takes out traders, gets new traders in, right? Comes up, boom, takes out these traders that were short, gets new traders in, boom, new leg, takes out that low. Now we reverse all the way back up. We take out this recent high. And guess what? That is a market structure shift, right? In a sense, but we'll get into blending everything together in a couple weeks. And then we come down, make a higher low, right? We save those lows for later. And then we come up, we take a high, we take out these traders that are short and in profit, get new traders in somewhere around here. And boom, come out and take out all this liquidity. And then now we're ranging. Now we have new liquidity to work with. Don't worry, guys. If this seems a little overwhelming, go ahead and rewatch this back if you want. But yeah, that's pretty much what liquidity is. Okay, liquidity is just going to be. Let me write this up real quick. Liquidity is swing highs, swing lows. All right, that's all it is. All right, in the most simplest way I could put it, like that's all it is. You don't have to overcomplicate anything. All right, me simplifying this for myself is what helped me like make a lot of money in these markets. All right, it's what has helped me make a lot of money in these markets and still continues to do so, is because I simplify everything from the top to bottom. All right, and that's what you guys need to do as well, in my opinion. That's just my opinion, though. Somebody else can disagree, but liquidity is just old swing highs and old swing lows, or stacked highs or lows. That's it. That's all it is. That's all it is. Our job in the academy, and what I'm going to teach you guys, is we're going to be attacking these old swing highs and swing lows, or stacked highs and lows. That's it. That's it. Think of it like a game. All right. But I hope you guys enjoyed this intro to liquidity video. The next video, I'm going to be giving you guys the homework to do over Sunday. So get ready. All right, because this is in the next video. I'm going to show you guys what to do. What is your homework? So it's up to you to do the homework, so that way you get familiar with everything that we've talked about so far. Hope you guys enjoyed the video. Catch you guys in the next video. Peace.